All right, uh, David. And thank you to all of you. Very much different times that we live in. I'm already down in Panama City getting ready for the Growers Conference. Certainly looking forward to seeing some of you here later this week. Been traveling the last several days, couple of weeks as we update our rep farms. And what I want to take some time today to talk with you about is as we look at crop insurance and how its effectiveness works for our peanut farms and some of the things that we've been saying. And this is some continuing research that I've been doing over the past couple of years, just to kind of touch base. We all understand the importance of risk management to American agriculture. We know that agriculture is no doubt a risky business. We see risks from the business side, from natural disasters. Producers need to learn to manage that financial, marketing, production, human resource, and legal risk. That's from the USDA. And as we look at exactly what is risk management and understanding that, and it's that process of identifying, evaluating, and prioritizing the potential risk that could damage, loss, or reduce our productivity in our operation. When we really have this risk management, it helps to empower our producers to make those informed and effective decisions so that they can try to avoid, mitigate, or even cope with some of those risks. And an effective plan to manage risk seeks to transfer or mitigate that risk. Specifically, as we look at crop insurance, it seeks to transfer that financial impact of the potential risk related to the yield or revenue declines. And as we've seen in recent farm bills, we've really seen the shift towards crop insurance as that basis for the safety net. We've seen where that, certainly in the Midwest seems to be accepted and really found as that foundation. But we're seeing something a little bit different as we look at our peanut farms. And the more I dig into this crop insurance, I consider it like an onion. I just keep peeling back layers and finding more and more layers within that. So, every time we make some headway, there I uncover something else. So this is certainly a continuation in progress. But as we look at the peanut producers, they do not always share the same sentiments as producers of other commodities or in different regions. We understand the diversity of a typical peanut farm. When we look at a peanut farm, we're not just growing peanuts. We're growing cotton, corn, maybe wheat, have some livestock. We see much more diverse operations and what's needed for our rotation so that we can keep those yields. We can't underestimate that importance of production management. Our management practices are often key for maintaining those yields and qualities that we need. We know that we've got to have the rotation. 3-year minimum is, certainly suggested. We're seeing some tighter rotations, but the longer it certainly helps. As we look at our crop insurance and understand, that 10-year APH and trying to get that 10-year yield history, that's where we really got to consider what is that impact and how do we see that being beneficial to our producers when we look at what it is they're trying to do in providing that safety net. Here with this slide, this is based on some prior research that we had completed, that I completed. When you look at that crop insurance by commodity, we've got a couple of things going on here. The brown line, that's our peanut crop insurance premium. The gold line is our cotton, and then the gray is the corn. These are the most frequent commodities that we find on our peanut representative farms that we use. And these farms are spread, the solid lines are in our southeast. The striped lines here are in our VC, and then these striped lines are in our southwest regions. But as we look at this, we see great variability in what it is costing per acre for that crop insurance. So as we look at different commodities within a farm, we're seeing great variability. As we look across regions, we're seeing variability. So we're trying to really figure out what is going on here and how can producers use this to be their best advantage with a safety net. So as we dig a little deeper and look at our yields, we have a couple of different types of yields that we're looking at with our models. When we think about an expected yield, that expected yield is that mindset when our producers go in to this crop year, what is it that they're realistically expecting their farm to be able to produce? This is the value, when they go to their banker to ask for the loans, they're expecting that they can maintain and, achieve this level of yields. And that's going to dictate their management practices on the production side. When we look at that payment yield, which we collect on our farms for our different bases, we're seeing some significant differences there in a lot of time. So that kind of posed me to start asking additional questions. So how does that compare if we were to consider our T yields for a county average? So the next step there, I added the green line. And this green line is our 10-year T yields for our counties that each representative farm represents. And what we see in a lot of these areas that really stood out to me, if we take Farm A, for example, which is down in Southwest Georgia, they're shooting for a yield of 5,500 pounds per acre, whereas their crop insurance T yields maybe 4,500 pounds per acre. And then when it comes to their coverage level, they're only going to be able to, at a max, get 85% of this T yield, if that's closer to their 10-year average APH. So we're really seeing some discrepancies and really questioning, is that truly a safety net? We've seen quite a bit, we do have a couple of counties here out in, this one's in the VC region. The 10-year T yield is actually higher than what their expected yield is. But for the most part, we are seeing that the 10-year T yield is significantly less than what our producers are actually managing and producing that crop as they're going forward. As we kind of look at the types of crop insurance, look at our peanuts farms, definitely with peanuts, yield protection is our predominant method that they're choosing. Very small acreage with catastrophic and a little bit with revenue protection. When we shift over to the cotton acreage, we are seeing an increase, more of a revenue protection, followed by yield protection and a limited amount of catastrophic. And corn is kind of reversed. We're seeing a higher level of catastrophic, followed by yield protection, and then revenue protection. So then we ask coverage level. As we look at these 10-year T yields, that's really got my mind thinking, is this some of the reason that our farms are not seeing crop insurance maybe as valuable as other regions of the nation as far as the safety net? And as we look at our coverage levels, about 76% of our farms are falling between that 60 and 75% range coverage level for their crop insurance. So what I've got here, I apologize, there's a lot of numbers on this slide, but as we look at this, the first column, we've got each farm, and then each row is looking for that farm. As we compared the T yield to the expected yield, we see for Farm A, that T yield is about 80% of their expected yield. If that farm chose 85% coverage, their yield that they're looking at as insurable is only 3,689 pounds, or 68% of what they're managing applying inputs, expecting that crop to produce. Well, we saw more of our farms are more around this 65% coverage level. So when we apply the 65% coverage level to the 10-year T yield, we're only looking at guaranteeing 52% of what we're managing, expecting that commodity to produce. We see these ranges through here, some as low as 23, for an overall average of about 53% when we're looking at the 65% coverage level. At this high 85% coverage level, at best, we're looking to guarantee 69% on average of what our expected yield is. So as we try to draw some summaries from this, there's still a lot of unanswered questions. You know, seeing this onion is bigger than I realized as we continue to peel more and more layers back. But, you know, certainly trying to figure out what is it that we can do to make crop insurance be that safety net that our peanut producers need. There does remain to be a mix of policy types and coverage levels within and across the farms. The average cost per acre for all commodities when we look at crop insurance has ranged from $6 to almost $62, which points to a lot of variability in its value as a safety net. As I've talked to a lot of producers, as we're currently going through updates for our rep farms and just looking at some other interactions, we're seeing a lot of variability with that really. We're seeing differences county to county in what the crop insurance is costing. We did see the 10-year T yields range from 35% to 109% of the expected yields. And it's key to remember that producers are managing the crops based on those expected yields. But in the case of an insurable loss, the potential coverage is on a much lower yields. The indemnities and cause of loss were highly variable between the years, but a lot of times those cause of loss came late in the season when a producer could not realistically turn off that high cost production management. And again, the one thing that keeps coming through to me as I talk to individuals is the importance of that knowledgeable crop insurance agent. That is key. Having an agent that really understands the products that's available and what's going to work for your farm. As I continue with this research, we're looking at some trends and indemnities across commodities. We're looking at the updated decisions regarding crop insurance as we're getting ready, gearing up for this next farm bill. We're investigating the differences between the different choices and looking at some of those production harvest factors. With that, I believe my time is about up. I want to say thank you for the continued support of our peanut economic research. And with that, I will open it up for questions.
Sure. Audrey, thanks for a great presentation and a very informative one. We've got one question for sure right now. Let's see. And it's from Foy Mills. Do you believe the representative farms are truly representative of their respective areas if their projected yields tend to be higher than county yields?
That is certainly something that we've been discussing with them greatly. Over the last week, we've already conducted, I think, 4 or 5 updates. We've got, I think, 8 more before the next 2 weeks are over. So certainly in a busy time with that. But this is something that we are truly hitting and really asking with them, making sure as they update their numbers, as we get ready for this next farm bill, to make sure that what we're putting together is truly representative of that area.
Okay. And we've got one more question. We'll go ahead and try to get that. If the farmer, and this is from Chris Butts, if farmer's stock peanut price structure were changed to reflect aflatoxin contamination rather than seg 1, seg 3, that ratio, or maybe just slash, how do you think that would affect crop insurance coverage choices?
There's a lot of ifs there, but certainly, depending on what came out, I think it could be a prime time that some of the pricing, maybe the revenue pricing model that has not been as well accepted on the peanut side, that may be an avenue that we see some changes and structure it where they can meet up, and that'd be best.
Okay, thanks a lot. Thanks for the presentation, and